All right, everybody. We're about to get started with our latest webinar of Viking Capital, where we're introducing our newest submarket and our latest deal, MainStreet Village. We're just going to wait for a couple more minutes while a bunch of people are logging in, and we'll get started. All right, it's 7:01, so we'll get started. So I'm really excited to present our latest project, MainStreet Village. This is Viking Capital's 16th project, and Viking Capital as a team with our newest partner ends up being our 23rd project. So very excited. But before we get there, let's welcome to the webinar our latest uh, investors, all our established investors. Again, we're very grateful for your support and your trust in investing with us. I also like to welcome all our new investors, and we're really excited about sharing who we are, our company, our projects, and how we can help you grow your wealth. So, uh, as you guys know, we are a value add company. We buy large apartment communities in select growth markets across the United States. And our number one goal is capital preservation. And our number two goal is growing your wealth, your investor wealth. Um, we've sold over 9 deals during the last 6 years, and we've generated over $41 million of value. And again, we say that with a hint of pride because, again, our goal is to improve our communities, grow our investor wealth, and also help the planet with green energy projects. And that goes into our bottom line. But before I get any further, I want to introduce one of the co-founders of the company and also our CEO, Ravi Gupta.
Hey everyone, thanks Vikram, and thank you all for joining us. To our old and new investors, we're very excited to have you on this particular project. So just a little bit about me. I am the COO or the Chief Operating Officer of Viking Capital. A bit about my background. I grew up in Northern Virginia. I went to school locally at the University of Virginia, went there for undergrad, for medical school, did some training at UNC and Duke, and then came back into the Northern Virginia area to practice as a hospitalist in inpatient medicine for a number of years. But during that time, I had a considerable amount of real estate experience, about 20 years in total, starting from when I bought a condo in residency and rented out a room to one of my roommates, all the way to now in Viking Capital, where we are looking at our 16th and 17th acquisition. So there's been a tremendous amount of learning during this process. Where I really got my boots on the ground and my feet wet was in a small multifamily portfolio project that I did with my wife. We bought 4 properties that were pretty much total gut rehabs in DC, and that created some financial freedom for us to go part-time in clinical medicine. But now I've pulled back mostly, and all my time, full-time, is with Viking Capital, though I do some work at the hospital in times of need, such as, when there was the pandemic was hitting, I helped out then, and I go back here and there. But most of my time now is with Viking Capital. A bit about me personally. I have 2 kids, married with 2 kids, and very much enjoy spending time with them. My interests include travel with them, reading, philanthropy, functional medicine, which is the medicine of health and well-being, and also very interested in environmental sustainability, as is our underlying value system: people, planet, profit. That's my value system, and I'm excited to share with you something that's really cool that we're doing on this particular property in that regard. So that leads me to the top 5 reasons I like this property, MainStreet Village. After I go through those, I'll turn it over to Vic to continue on. So number one, the reason I like this property is its location. It's located in Granger, which is an affluent area in the South Bend MSA. It's directly located across a major hospital called St. Joseph's Regional Hospital that employs 2,500 plus employees, and it's very close to Notre Dame and St. Mary's University. So it's the whole med ed thing, medical and education, and that is a great combination to have, especially obvious during the pandemic where COVID really didn't have much of an effect on this particular property. The second reason I like it is it's vintage. It's a 2001, 2003 build, high ceilings, built-in desks, office nooks, crown molding, oversized windows, attached garages on the units. You literally enter through the garage and walk into your unit. It's a very nice looking property, institutional quality, and incredibly well maintained. The third reason is growth in this area. There is a lot of growth. There are new properties coming up online where the absorption of these new units is quite rapid. One of the competitors that we toured on our visit there was 100% occupied. The job market is predicted to grow at 36.7% in the next 10 years, and it's on the Forbes ranked. On the Forbes list of ranked cities and job growth. So a tremendous amount of growth here. The jobs are stable in the medical and education industry, as I was mentioning. That's the fourth reason. The fifth reason, taxes. Interestingly, this property taxes has been decreasing over the past several years. We called the tax assessor's office to figure out why this was, and there were literally no comps. And the way they determine the tax rate is based on comps. So the taxes have been decreasing. So we didn't try to push any further and shoot ourselves in the foot, but we left as is. We understand that it's going to continue to decrease. Of course, we didn't underwrite that, but it's just another perk. And the last perk I'll share is the Zome system. Now, this is something I'm very excited about. I just signed a contract today with Zome, and what Zome does is they play in the energy markets. So they have an AI device that hooks up to every building, and then they exchange all the thermostats, water heater and standard thermostats, where it's controlled from this AI device. And when there's a huge amount of demand in the area, the load drops in the entire property. And commercial retail rates are very high, so there's tremendous savings in that load dropping, and that savings is shared with us. So to start, we'll get about $90,000 worth of free thermostats installed that the tenant can control themselves with Wi-Fi. So they're really high-end thermostats. And then subsequent years, we're going to get anywhere from $20 to $40 to $60,000 per year in shared profits. That's not part of our underwriting, but it's something very cool, energy savings, and makes sense financially. So a lot of great things happening with this property. So those are my 5 reasons, and now I'll turn it over to Vic.
Thank you, Ravi. Excellent information there. I would like to share with everyone here, who I am. My name is Vikram Raya. I'm the CEO and the co-founder as well, alongside Ravi of Viking Capital. We started Viking in 2015, but prior to that, I was an established cardiologist, worked in a large practice, and then also I've been an entrepreneur on the side as well, running 2 successful businesses, and I've been involved in real estate for the last 10 years. We formed Viking Capital in 2015 to move into larger scale properties beyond just single family and retails projects. And we wanted to really scale, leverage, and grow our multifamily company. And the purpose is to help our friends, family, investors, and the greater professional community at large earn significant returns without the risk or the volatility of other asset classes. So we've been on a sort of an acquisition cycle for the last few years. We've had some very successful exits, as I mentioned, with the 9 deals being sold for $41 million of value added. We've recently brought on our latest partner, Deepan Patel, who has a significant amount of multifamily experience himself and adds a lot of boots on the ground as well as to being in the Atlanta uh, MSA. And as we look forward to going on this journey with you and partnering with you, as well as our former investors and our new investors, a little bit about me personally. I'm married. My wife, her name is Ramona. We live in the Northern Virginia area. She's a rheumatologist. We have two young kids, Veer and Armand, who are 10 and 8. We like to donate to a diverse group of charities across the world. We recently, as Viking, and personally, we gave a shipment of oxygen concentrators to COVID relief in India. We've helped do with our charity galas. We've done help empowerment of girls in Africa and Asia. We've given free lunches to kids in the DC area. We sponsor water and green energy projects. So again, we go way beyond just a traditional real estate company. But with that said, our objective tonight, guys, is to show our newest submarket, which is Indiana, and our newest asset, which is MainStreet Village. And we're very excited and honored to share this with you guys. We really want to talk about the asset and why I think you'll be very, very pleased. You can see here that it's a gorgeous looking property, large clubhouse, large ample green acreage and space. And so before I get into that a little further, let me tell you about our team. Again, Viking Capital is been growing over the last couple of years. We have a large team in place. We have a director of acquisitions, Judah. We have our asset manager, Matt. We have a investor relations in Ben, operations manager in Amanda. We have an underwriting team with Nathan, and Alicia is our investor services manager. So once we open up this investment for reservations, Alicia and Ben will be help servicing you guys and getting you through the process. Our strategy is really to buy in primary, secondary, and tertiary markets. The primary markets, we're really looking at Atlanta, where we've done 8-9 multifamily transactions. We've done 3 deals in Dallas. We've done deals in Austin as well. We have a deal in Washington, D.C. But now we're moving on to some elite submarkets in secondary, tertiary cities, such as Granger and South Bend, which is in Indiana, and other submarkets, which we'll be bringing to you over the next months. Our basic business strategy is value add execution, which is finding opportunities with well-maintained assets that have not been renovated or not been optimized or modernized, if you will. And we're coming in there, renovating the exteriors, improving operations, upgrading the amenities, and adding our level of expertise and professionalism to the asset in order to drive the NOI of the asset up. We've been busy over the last couple of years acquiring assets. We have, a total of, I think this is like 23 assets total between us, Ravi and I, and our newest partner, Deepan. And again, the submarkets we've already operated in is Atlanta, Dallas, Austin, Washington, D.C. We've had some excellent exits already. We've exited these 7 or 8 assets. Our average IRR return to our investors, our average annualized return to our investors is close to 26%, which is, again, very robust. These are the current assets we have under management. But now let's really get into the MainStreet Village. MainStreet Village is a 400-unit asset located in South Bend, Indiana, which is one of the most affluent submarkets in the Midwest. We're really excited about this deal, again, for the reasons mentioned by Ravi, but also, again, South Bend is home to University of Notre Dame. It's number 15 university in the country. It has 12,000 students. The tenant base of the property is, again, what we've called the med and ed sector. Tons of medical professionals, educators. There's also a ton of finance and retail tenants as well. The location is absolutely amazing. I'm really excited because it's a wealthy, prosperous, and affluent submarket, one of the highest we've ever invested in. The average household income of Granger is $150,000. The tenant base on MainStreet Village is about $86,000. So what that means to us as multifamily investors is you want an income to rent ratio that's about 3. The income to rent ratio on this property is close to 6. So again, the affordability is not a problem. And even if we raise rents, even a couple $100, they're more than capable of paying it. And again, they're looking for more of an luxurious, affluent amenity upgrades. Again, while we like the properties, the rent growth has been strong, very stable. Currently, it's 97 to 99% occupied. It's extremely low vacancy and did very well and very recession and pandemic resistant. It did. There was essentially less than 1 to 2% delinquency on the property during the pandemic. The school districts here are excellent, by far one of the best in the submarket. It's right across the street from that tertiary care hospital, St. Joseph's, which employs 2,500 people. It's a 300-bed tertiary care hospital. There's a large luxury mall just down the street. There's a Whole Foods within 5 minutes of the property. The property itself is very desirable with a large pool, outdoor grilling station, full basketball court, fitness center, tanning salon, and dog parks. There's a tremendous amount of square footage on the units. And something very unique, and you can see here in this picture, there is a garage attached to many of the units, and you can have direct access from your interior of your unit, which is essentially unheard of in apartment complexes. So with all of this, you may say, hey, is there any risk to the investment? And yeah, there's always a risk when you invest in anything. But what we do at Viking Capital is we try to mitigate any of that risk by focusing on capital preservation. We choose high quality assets that are stable in ownership with tremendous amount of upside with very little downside. The second thing we do is with our asset manager, with our underwriting team, our acquisitions team, as well as our property management company, we execute our business plan. Because if you don't execute your business plan, you're not going to be able to increase the value of the asset. And we also stress test our assumptions. We want to make sure that we're using very conservative underwriting, and we also factor in many worst case scenarios so we're able to withstand any storms that may come our way. So let's move on again about the asset itself. As I mentioned, huge resort style swimming pool, expansive outdoor lounge area. There's a nice clubhouse, very luxurious, that can definitely stand to be upgraded. But again, it is one of the best in the submarket. This is the hospital that we were mentioning, that literally you can throw a football from the parking lot of our asset across the street to where this is located. There's also hundreds of small medical offices sprinkling in the surrounding area of MainStreet Village. Here is the investment summary. We are buying MainStreet Village at a 5 cap. And to put that in perspective, I'm going to bring on Judah, our director of acquisitions, to sort of share with us sort of the lay of the land. We at Viking are not only regional players, we've sort of become national players. We're looking at large value add assets all over the country, and we underwrite probably 100, 200 deals to find one deal that works. And so I'm going to bring on Judah to discuss again how rare it is to get a 5 cap on in this current market with this quality of an asset.
Yeah, thanks, Vic. I mean, it's a great point. Right now, if you look at the market, you look at high-performing markets, you're seeing deals, if you're lucky, go in the mid-4 caps. I've spoken to companies and brokers where they're trading on deals in the 3 cap range. So this deal on the trailing T3, T12 cash flow is looking at just above a 5 cap. And what's amazing about that is that this property is just a strong performing property. You already mentioned the average income on the property, the average income in the area. Just to give you an idea in terms of delinquency, this property has seen less than 1% bad debt over the last year. And by the way, the last year included the toughest times of COVID when it comes to rental assistance. Additionally, even right now on the entire property, you're talking about, not including the month's rent due today, you're talking about $11,000 delinquency on this entire property. That's absurdly low. This is a strong performing asset. Another way we're, the risk mitigation, which kind of, when we look for asymmetric risk reward, this is kind of, the mitigated risk on the property. I know you'll talk more about this, Vic, but this is a 2001, 2003 vintage property. It's relatively new. Not only that, but after the developer, there was only one other owner on the property, and that was DRA in partnership with Marquette, two institutional quality owners who took care of this property like institutional quality owners do. So what that means for us is less deferred maintenance, less unexpected work. We know we're buying property from a company that's worth its weight in gold, and that, as we've seen on other acquisitions, translates to lower costs and lower deferred maintenance going forward. So this is a well-maintained asset, and we, like as Ravi and Vic had mentioned, there's numerous revenue streams, Zome being one of them, that we think and we're confident we can achieve, that we haven't even included in our underwriting just to be conservative. We're doing everything we can to be as conservative as possible on this underwrite, including that there's a corporate tenant who pays almost double rent for their units, that over COVID, because international travel, it's a British company, was kind of reduced, has wound down to a couple of units from about 15. We've underwritten going forward all the returns you're going to see as including none of that income. We've already engaged that company in conversations, and they fully plan on ramping back up that program once international travel, which has already started, to reopen again. There's water savings. Right now, they haven't installed any water savings devices on this property. And just by doing that alone, which comes out to less than $100 per unit, we can cut our water costs by 30 to 40%. So there's so much potential for this property. It's such a strong performing asset by way of collections, by way of rental payments in it, that we're more than confident going forward that it'll continue to do so. And one more point, if I can just make it, is that, and when it comes to the unit interiors, where we can really add a lot of revenue, since construction, ownership has only renovated 170 units to various degrees of partial renovations. 14 have been renovated recently to kind of this high level that the market's asking for. That leaves us 230 untouched units where we can just renovate the units and see that rent increase to market rents. And that's where we can add a tremendous amount of value in combination with the market growth we're seeing. So for all these reasons, I'm excited about the property. And these are all reasons that we're so thrilled to be seeing a 5 cap property for what's truly a kind of a diamond in the rough in MainStreet Village.
Thank you, Judah. Excellent, excellent. So with that said, we're at the level where Viking is certainly buying deals more from institutional buyers, and DRA Advisors, the owner of this property, is a large multi-billion-dollar institution. They're a $12 billion equity fund. That this is one of their trophy assets, and so it was a heavy competition to win the asset, and we ended up winning it because of our track record. But we like buying from these types of sellers, as the properties were well kept, not much deferred maintenance, but even though that they did a good job in maintaining the asset, they've not done a great job of doing a lot of the full property renovations, which it provides an excellent opportunity for us. So our money can be really targeted for revenue generating improvements on the property, which will raise NOI and thereby cash flow and the value of the asset. So the purchase price is $76 million. The hold period is 5 years. We're raising $19.6 million of equity, of which Viking is definitely investing at least high 6 to 7 figures in this asset. There's a Class A and a Class B, which I'll talk about in a second. But the returns are, again, what we like to achieve for our investors, that 2x multiple, which is now harder to achieve than ever in many some markets out there. That's one of the reasons why this deal really was exciting for us to bring to you guys. And again, that 20% annualized return is what we're projecting here. So the reason South Bend is an ideal location is it's only 90 minutes from Chicago on fast rail, which is located conveniently close to this asset. It's 160 miles from Indy. It's only 100 miles from Toledo. It's located right on near the Great Lakes. The surrounding area has tons of employment, tons of things to do, top employers, significant educational system, obviously the medical system out there, and near major interstates of 90 and 80. Granger was number 3 best city for young families in Indiana. Top 10 cities for high-tech innovation. There's actually 2 technology hubs affiliated with University of Notre Dame that are employment drivers. This is ranked one of the top 40 hottest real estate markets for business. So again, very powerful sub-market. Some of the top employers in this MSA are University of Notre Dame, Press Ganey, 3 hospital systems, including St. Joseph's, Elkhart Hospital System, and Beacon Medical Group, Honeywell, which is a major employer. There is a diversity of different employment opportunities here, and it's considered a top 150 city for job growth. The strength of the South Bend market, specifically the Granger submarket, is obviously very evident here. The Press Ganey, the Beacon Medical System, St. Joseph's, over 6,000 people locally. The University of Notre Dame has 3,500 employees. Within a minute of the property, you're at the hospital. 11 minutes, you're at Notre Dame. 7 minutes, you're at the Whole Foods. You're near all the major retailers within 5 minutes. The luxury mall called University Park Mall is only 8-minute drive away. The train station that takes you to Chicago, which is a 90-minute train ride, is only 25 minutes away. And again, direct access to all the interstates. University of Notre Dame, one of the major drivers of the economy in South Bend, top 15 university in the country. Occupancy has been very stable over the last almost 10 years here. Never dropped below 90% in South Bend. And then this particular submarket of Granger is even higher, 95%. There's an aerial photo here of all the retail, the shopping, and also the interstates. So our business value add strategy here is going to be currently, that's already located in the best school district. When you go visit the property, it's a peaceful, tranquil community, upscale location, premium restaurants, shopping, retail, big box stores, and high-end car dealerships are nearby. During our visit, Ravi and I and Judah, we were doing due diligence on the asset. We noticed nice cars on the property, well-maintained asset. The current manager, which we plan to keep, says the tenants are loyal, they're friendly, less than 1% delinquency during the pandemic. This property is going to be a blank slate for Viking to add value to the asset and upgrade the amenities. The exterior value adds we plan to provide are really our typical bread and butter that we like to do. The pool is very nice and large, but it could use some upgrading, which I'll show you in a second. There's a large amount of acreage and green space, but there's no playground on site. There's a ton of families there, so we can add that as an optionality. There's a full indoor court for basketball. We're going to upgrade that. There's a fitness center, which is very nice, but it's a little dated. So we're going to add modern equipment, including CrossFit equipment, functional fitness equipment, fitness on demand. There is some outdoor kitchen space, but we're going to add more outdoor kitchen space, pergolas, hammocks. We're going to create an awesome dog park. The landscape is going to go up 2 to 3 notches so we can create a lush and inviting space for our tenants. Ravi's also working on a tenant service package, so all these bonus amenities that we can outcompete the competition by them wanting to stay in our asset because of these extra amenities we'll offer to our tenants. The clubhouse is going to get a major makeover, even though it's very large and it looks nice. It's from the sort of the mid 2000s, and so it could use an upgrade or refresh, if you will. We're really looking for that huge wow factor when you walk in there. And so for the interior renovations, again, only 23 units have been really fully upgraded. And so we're going to upgrade the remaining 77% of the units. We're going to do 75 units from partial to full renovations, and 230 units, we're going to go from classic to the platinum elite renovations. So for Viking, what that means is really these oversized windows, stainless steel appliances, crown molding, washer and dryer, quartz, bar style countertops. We're going to upgrade the lighting, the bathroom fixtures, new mirrors, plank vinyl floors, USB ports, some of the things that Ravi was mentioning with the Nest thermostats, the gooseneck faucets, tile backsplash. So it's going to feel wonderful living in this sort of almost condo style quality apartments. And we've already proven out that the previous owner, the 14 platinum units he renovated, they are already on, there's a wait list to get into them. And half the people who already lived on the property decided to upgrade. So that shows you there's a pent up demand for this luxury finishes. And so when we're done with our business plan, we're really going to have a new improved property on our hands. The resident quality of life will be dramatically improved. It'll be a better community for families, and we'll be more able to effectively compete with high quality tenant base. And that's why we think this is going to be the right deal, the right asset, the right market. And we feel this is the right opportunity for our investors. Again, this is what the classic units look like. And I just showed you what that platinum renovation is going to look like after we're done here.
Yeah, Vikram, if I could add a few things. So when I walked the property, as Vikram mentioned, my feeling was the exact same. It felt very warm, friendly. It was spacious, and it certainly had a feel to it where I would feel comfortable living there. And I don't say that about every one of our apartment complexes that we have, but I certainly felt that about this particular one. Also, when we looked at the competition, there was another property that we saw, Villas on the Fur, which is one of our competitors. It's a newer property, 2018 vintage, same style as this one, but obviously newer, and everything looks like the platinum that we have. And they're 100% leased up. There was a wait list to get in, and by that I mean literally 100% of it. We couldn't even tour a unit. We spoke with the property manager, and she said there's a huge demand for these high-end units. People are willing to pay for them, and it's proven on this particular property in the platinum units. That particular building is a fire building, so to speak. It was damaged by fire and got rebuilt to this platinum level. So it had a really nice new feel to it, and it was proven that you could get those types of rents in this property as well.
Great, Ravi. Thank you so much for that
Sure.
added clarity here. So here's an aerial view of the asset. You can see here it's a large amount of green space, large amount of acreage. That's where we're going to really invest in the landscaping. There's a beautiful lake in the middle with a fountain, both on this side and right next door. It's hard to find this kind of asset anywhere in the country, really, to be honest with you. With this, plenty of parking. There's individual garages that are connected to most of the units, which I haven't seen in many submarkets. And you can have direct access from the interior of your apartment. The current ownership is not even charging full upgraded rents for those units. So that's another income stream that Judah and then the asset management team will definitely take advantage of. And here's the location of that hospital. As I mentioned, literally adjacent. The mall system is right here, very close by. So going to the rent comps, there are at least 6 other properties which we are currently in the same asset class of, and our average effective rent per square foot is significantly lower. Ours is $1.24, and everyone else is in the $1.50s, $1.40 range. The average effective rents is significantly lower. We have almost 170 to close to $500 headroom on rents, especially in the 3 bedrooms. We are definitely underpriced there. The 2 bedrooms as well. And so there is a significant amount of room. In our underwriting, we've chosen to just use between probably $150 on the full renovations that we're going to plan to do. And on the elite platinum level, we've only chosen to use $250 as our rent premium, even though you can see here there's a significant amount of headroom. In terms of the financial analysis, we're buying it at an excellent cap rate of 5%. The debt service ratio, especially after year 1, comes to close to 2. So what that means for those of you who are newer to multifamily is debt service is what you need to pay to service the loan. And so you want to have enough income on the property to do so. And a ratio of 1.2 to 1.3 is sort of the minimum you need to buy a property. we're buying it at 1.7, and then after our optimization, it's going to get to 2. So a very safe asset, very conservative asset, churning off a significant amount of cash flow, thereby not only clearing the hurdle of debt service, but also allowing us to pay our investors a significant return. That's why we're giving some of the strongest returns we've ever given on a multifamily asset on this deal. And I'm going to get into that next. So there is 2 classes of investors. And so investors have optionality now when they want to invest in our projects. We have a Class A partnership structure and a Class B partnership structure. The Class A partnership structure is for people who really enjoy cash flow. And so we're giving a 11% preferred return to our investors for the years 1 through 5 of ownership. Class B investors are investors who want some cash flow, but they also want to participate in the upside of the sale and of the profit. And so we're giving an 8% preferred return to investors with a 70-30 split on cash flow and 70-30 split on membership ownership. If you're a typical $1 million investor or $100,000 investor, essentially you're getting a straight 11% return across the 5 years. It's a 1.55 multiple, and average cash on cash obviously is 11% for Class A. For Class B, it is an IRR of 17%, which is very robust, an equity multiple greater than 2, and that again, that average cash on cash is 8%, and on average cash on cash may even be even higher on this project.
Vikram, if I could just quickly add, the preferred return for the Class A investor is 11%, which Vikram mentioned, but I just want to reiterate that because it's not very common. In fact, I haven't seen a deal where you have that type of Class A return. We just feel very confident in the numbers and the cash flow in this particular project. And we've already seen in the past couple months a significant increase in NOI, and we feel quite comfortable that this will continue. And we modeled this in multiple ways, and we feel that the 11% is completely achievable, and including the 8% Class B preferred return, which we haven't seen this combination before, but this is something new we're doing, but certainly very achievable, and we really think it makes a lot of sense to our investors.
We also like to do a sensitivity analysis, and you could find that in your packet when you were able to download it. But depending on the various cap rates, there'll be varying IRRs here. So again, we don't have a crystal ball to predict the future, but what we've done is capital preservation, strong business plan, execution, strong team on the ground in order to achieve the best possible return for our investors. The debt we've chosen to do is we've gone to, due to the current business plan, which is for us to invest almost $4 to $5 million of capital expenditure to upgrade this asset. The debt that made the most sense was a private loan, and so we are doing a private loan on this project. The interest rate probably will be between 3.2 to 3.5%, depending on when we lock the rate in. It will be a floating rate, but what we've chosen to do is purchase a cap. So it's a very tight cap, so the rate will not float beyond a certain point. This is a 5-year hold with 5-year interest only, again, allowing us to use more of our money for the purposes of improving the property versus for debt service. The other thing we've done is a break-even sensitivity analysis. So at year 1, when we first take over, the break-even is at 70%. Remember, this property never, in the last almost 10 years, drifted below 90%. So the break even is 70% year 1. And then after we stabilize a property, which is in between 18 to 24 months, it's going to drop to 58%, allowing, again, showing the safety of the asset, showing how strong the asset is and the in-place cash flow, and as well as our execution of our business plan. Here's a pro forma, and you can see here a steady marching up of the NOI over the next 3 to 4 years.
And Vikram, if I could add 2 slides back, we look at the break-even occupancy, 70%. That's 70% occupancy. When you look at data going back a number of years, and we can pull that with various databases, This property has never gotten to a 70% occupancy that we've seen. It's the lowest it's gotten to was the high 80s, but it typically is in the 90s and currently in the mid 90s. So the break even is lower than it's ever been year one, and then at stabilization, significantly lower than it's ever been. So that's another comforting number here, knowing that this is where the break even point is if things really go south for whatever reason.
Our property management company that we like to use is First Communities. They manage over 200,000 units in the country. They're one of the most dominant players in the eastern half of the country. We have a good relationship with them. And as we own a significant number of assets now, they formed a specific Viking Capital team within First Communities that really manages just our assets. So we almost have like a sort of a surgical strike team here that can really be very nimble, quick, responsive, and rapidly execute the business plan and have quick awareness of what's on the ground, and we can adjust very quickly as we continue to deliver on our interior and our exterior renovations, as well as our tenant up-leveling strategies. So with that said, what I'm going to do is open up the offer for this asset so you guys can make your reservations live. All you have to do is click on that green button here. And for those of you who are in 2330, we're also making sure you get access to the materials early on so you can get into this deal sooner, as we expect with these kind of returns and our track record. Again, this strong, robust market, this deal will most likely oversubscribe very quickly. So we're going to leave the webinar on and get a couple of questions in from the chat box. So if you have questions, please drop it in. But I already have about 6 questions here that I've been getting throughout the webinar. So I'm going to answer some of these. And then gentlemen, Ravi and Judah, if you want to just answer some of these new ones, we'll go from there. So the first question I got was, if you have any questions, how do I contact you guys? So these are the 2 emails, bcarter@vikingcapllc.com. If someone can just type that into the chat, and so they have Ben's email. He's our Director of Investor Relations. Our Director of Investor Services is Alicia Galloway. Her email is agalloway@vikingcapllc.com. We can put those in there so people can quickly ask any questions. We're readily available. The second question is about investor payments. So people are asking, hey, when do I get my distributions? We at Viking, for this particular asset, will be doing monthly distributions. And so, Ravi, when is that? Is that the beginning of the month? You're on mute, Ravi.
Yes, it's the beginning of the month.
Okay, great. You also will get monthly reporting from us with a newsletter and reporting about that specific asset. The next question was, hey, do you guys do cost segregation? Yes, we do cost segregation on all our assets. We'll be doing a cost segregation on this asset, and likely you'll have a significant amount of tax write-offs the years 1 and 2 of ownership. The next question was, how do you perform renovations while they're still in the unit? Well, we don't do occupied renovations. What we try to do is, since this is a cash flowing asset, we don't want to tank the income. So what we do is we aggressively renovate on turns. This allows people to enjoy the asset, and then when there is an opportunity for us due to natural vacancies, we quickly turn the asset. Now, sometimes people love their apartment so much, they'd rather stay in there and pay the increased rents, the market rents that we're going to charge, regardless of whether the renovation is done or not. We let them do that. The next question is, what's the number one risk on this asset?
Looks like Vikram froze there. Judah,
Yeah.
are you seeing the same? Okay.
Yeah, I'll chime in on a question that came in from the chat
Sure.
box. I think it's a very good question. And that question was about and I've gotten already a couple times, which is what people are saying is the high LTV. LTV is loan to value. It's loans relative to purchase price. And when you have agency financing, you usually see anywhere between 70, 75, 77%. Here, we're actually looking at a loan to cost basis. We actually had several private debt funds, funds that invest in real estate as senior position debt, competing actually to get the debt on this property. And they believe not just in the area and the property itself, but they believe so strongly in the renovation plan and our value add strategy that they were actually willing to lend us not just on the purchase price, which is LTV, but also lend us up to 80% of the cost of renovation as well. And that's so important because that mitigates the risk of having a well-capitalized project. As you know, Viking Capital, for those of you who've been exposed to our deals in the past, we really place a prime importance on being well-capitalized entering a deal. And to have a fund who's willing to actually be a partner with us in a way on making sure that all that renovation plan is properly funded is a tremendous asset. So what it does is it raises that LTV, which is loan to value, because we're really seeing on a loan to cost basis, and they're lending up to 80% of total cost. So you're kind of seeing the same balance, just you have to look at a cost basis and not just on a purchase basis.
Yeah. And another question that's come up multiple times is, why is the current owner exiting? This is an institutional owner, and they have a business plan that they have fulfilled, and that is why they're exiting. This is sort of a timed exit for them,
right?
And it just sort of part of their plan.
Right. They also invested in this deal out of a fund, which I believe was a 7-year fund, and as that fund has a time limit on it, so they have to return capital to investors. They're actually forced to sell the property, no matter what percentage of units they've renovated or anything else. So speaking with them, they're very happy with their progress, but they also were required to sell as the fund required it, which gives us opportunity to take over exactly where it is.
The next question I got was, again, about sort of our business plan and, can it offset any risk? And so, for all, this is our bread and butter multifamily for us. This is a value add reposition, and it's more of like up leveling rather than reposition. And so if our goal is, the key is to execute our business plan. So we already hit the ground running. We already have contractors, we have bids, we already have the team in place of what we're going to do. We have a business plan ready to go. First Communities is aware of what we're planning to do. And as soon as we take over the project within the next 6 to 8 weeks, we'll be hitting the ground running with the rebrand, the clubhouse. Now, a lot of this is challenging work because there's a ton of things going on. We're renovating almost 300 units. We are rebranding the whole asset. We're painting the exteriors. We're going to upgrade the clubhouse. We're up leveling the pool. We're adding a dog park. So, this is our 16th multifamily project. So we figured out the systems. We figured out the teams. We figured out structure and pace and cadence. And we feel very comfortable in doing this in a quick and expedited way in order to maximize the value of the asset. Again, as I mentioned, this is going to be a bread and butter project for us. And people ask, hey, does this deal compare to some of the other deals you've done? And I would say yes. If you've invested in Marabella Place, the Veritas, those are very similar type of heavy lift value adds that we've done that have really gone very well. Those properties are really crushing it. We're killing it on returns and exceeding our pro forma. So again, we feel very comfortable with this project. We feel conservative in our underwriting, and we want to be aggressive yet careful.
Vikram, two more questions. Number one, when you said what is the highest risk, the number one risk, it cut off. So if you could let us know that, and then also the minimum investment for Class A and B.
Sure. I'll answer the second one first. So minimum class investment for Class A and B. Again, we want to. There's a lot more new investors we're starting to get on top of our established and our trusted investors we've already had. So we want to open it up the door. So we're lowering the Class A investment to $50,000. So it's $50,000 for Class A, $50,000 for Class B as a minimum investment. The returns, again, Class A gets 11% preferred, Class B gets an 8% preferred, plus the participation on the upside, so they get a 2x multiple. Again, we're buying this at a 5 cap, and we're buying it from a strong institutional quality owner with very little deferred maintenance and tremendous amount of upside. The risk is really in multifamily is not executing your business plan, and again, we have those bases covered.
Another question is that we've been getting is, how can you renovate if the occupancy is so high? That's a great question. We don't want to kick tenants out of their units and renovate them if they're actually paying rents. So what we do is we renovate on turns, meaning that when a tenant exits the unit, then we renovate. And sometimes what we have been doing in the past, and as Vikram mentioned, the two of the other properties that are comparables, Veritas and Marabella, is we increase the rents to market on a classic unit. Sometimes the tenants, very often, in fact, more than you'd expect, they will pay those market rates, even for a classic unit, because they don't want to stay there. So we actually just wait till the next cycle to renovate that one. So that's how we do it. We increase rents. If they don't want to stay in that unit, they'll move to another one. Then we can renovate, or they pay that rent. And that keeps it. There's enough vacancies over time that it keeps us renovating units as they come up. I think Vikram is having some internet issues. Somebody mentioned they can't hear him, so I'm happy to continue on and answer these questions. Both Judah and I will do that. Another question: when do you intend to close? The end date for investor funding is going to be close to the end of July, sort of mid to end of July. I would say about a month, and then we intend to close early August. Someone asked, can you explain the 70-30 split? So what that means is 70% of the proceeds go to the investors and 30% go to the GP, which is Viking Capital and the other members of the general partnership. So there's a limited partnership, which are the investors, and the general partnership, which are sort of the managers and the people that are involved on a higher level in the deal. So that's what we mean by 70-30.
And just to reiterate there, that only kicks in after the investor's preferred return. So before a Class B investor sees the full 8% annual return, and cumulatively caught up to wherever they are in the investment, Viking Capital won't see any of that 30% until that the investor sees their 8% fully fulfilled.
Yeah. So just to reiterate, we're not going to see anything until the investors get their 11% for Class A and then 8% for B. Then once that happens, then we will see some of those proceeds. Somebody asked, which is better, A or B? Well, that's a great question, and it's really up to you as to what your risk tolerance is. Some people have a lower risk tolerance, and they say, hey, look, I'd rather get this 11%, which is a very good amount, 11% per year, and you will be the first bucket. So it's sort of like, you can think of it as buckets, right? So the cash, after all the expenses and the debt service and all that all those expenses, then the cash flows into one bucket. So the 11% Class A bucket fills up, and then after that fills up, it spills over to the Class B, then the Class B fills up. So that's how the waterfall works. So if you're more conservative, you go for the Class A. If you're like, hey, look, I like this deal, I think it's cash flowing well, I'll go with Class B because I can participate in the upside. So there's a little bit more risk there, but then you get the back end profits when we sell. There's some sharing of the back end proceeds there. So that's kind of the thought process of Class A or B. And you can blend it too. You don't have to do all A or all B. You can blend.
You can get the mall back and the Pinot.
Yeah, you can get a little bit of both. Let's see, some more questions here. So great question. Does your investment team have a presence in South Bend? And if not, who will see the renovation? So our investment team does have a presence in Indiana. This is their first deal in South Bend, but they are in Indianapolis, which is a very, very close, in close proximity to this deal. And all the vendors that they use have presence in South Bend. So it's going to be a very easy transition from Indianapolis to South Bend.
I have a question here saying, do both classes benefit from tax mitigation? Yes. No matter if you're a Class A or Class B, you both participate in the cost segregation and the depreciation benefits that we're going to provide. So I think we have time for a few more. A closing will be in late July.
Yeah, I answered that one.
Okay, great. Okay, should we? I think we have a 1 minute left before we wrap up.
Yes, you'll have access. Somebody's asking about access to documents. You'll have access to all those documents when you sign up for the deal. The subscription documents, the PPM, the operating agreement, all that you'll have access to. Let's see.
And just want to highlight that if you look on the top right, that make a firm commit button is how you get into the portal and sign up for the deal.
And last thing to note, we do oversubscribe on practically every deal. I mean, every deal we've done thus far. In fact, every deal we've done, we've had an oversubscription. So if you're interested, I would certainly recommend just getting your foot in the door early, and making your commitment early so you can get in on it.
So go ahead and press that green button, make a firm commit. Definitely want you to get into this deal before it does wrap up. We get a tremendous amount of investor interest across our established investor base, plus a lot of new investors who are excited about this project. So go ahead and press that green button. And otherwise, there will be a recording of this for those who missed the webinar. Thank you everyone for attending. I know it's in the evening time and you have time with your family, so we really appreciate it. Ravi and I are very thankful. And Judah, thank you again for providing some keen insights. And with that said, we're gonna go ahead and end the webinar, and we'll still leave the firm commit button up for a few more minutes.
Thank you, everyone.
Thank you.